I'd like to share with our panel here about a question that we asked you guys when you registered for the event. And we asked you what factors would affect the market for the next 12 months. And 28% of you guys answered foreign fund flows. Next being economic growth at 26%. Then 14% of you are worried about the escalation of the trade war. 13% are concerned about the performance of global markets, while only 11% are worried about inflation, while a smaller 9% are worried about the weakening peso. So I'd like to ask April once again, since the top answer there are fund flows, what do you think about this, April? What do you think is causing this problem? This is just for everyone's information.
Okay. So I think definitely fund flows are an issue. As you've seen, I mean, initially I was looking at this a few months ago, I was quite surprised to see that we only had positive net inflows in January, and that was it. I mean, initially I wanted to show a weekly breakdown, but it's just too much. So we accumulated everything. Pero consistent talaga every week. Net selling, net selling, net selling. And this is taking into consideration that we didn't have any net inflows actually since 2013, 2014. I think this is the funds that came in 08, 09, you know, when the market started to recover. So really, I mean, we saw a lot of that. So in a way, we were quite surprised about it. So there are many factors causing it. I think one of the reasons is, you know, you have the strong US dollar. And one of the reasons why we're seeing a strong US dollar is because the Fed is increasing rates faster than most central banks. Okay, and in June 13 this year, they showed that they have this Fed meeting every so often. So they had the Fed meeting in June, and then the 15 members were asked about their opinion on where do you think the Fed fund rate will be by end of the year. And based on the outcome of that survey, it implied that they will be increasing it another 2 times until the end of the year. And people were anticipating 1 more. So that was a faster than expected increase in interest rates. And because of that, that caused the US dollar to strengthen even further. So, you know, the peso is weak, yes, but it's not 100% our fault. It's also partly because we're seeing a strong US dollar. Okay, and you know, the relationship of the emerging markets and the US dollar is inverse, as you can see here. Every time the US dollar weakens, emerging markets go up. Every time the US dollar strengthens, emerging markets go down. So there is an inverse relationship between the two. Okay, and aside from that, you know, we now talk about, I think if you look at the international papers, you know, Trump is always in the headline talking about all these trade wars. And I kind of realize it's not only a US-China trade war, it's US against like everybody in the world, you know. And, you know, emerging markets, but the major target for the trade war really is China. And if you look at the emerging markets, China accounts for a big chunk of the emerging market index at 33%. And you have other highly export-dependent countries like Taiwan, South Korea, which are also heavily exporting to China, which is why, you know, I mean, we're part of this index, but we're part of the others. You know, I mean, if I were a foreign investor and, you know, I'm just concerned about emerging markets being affected by the trade war, I just sell everything without taking into consideration whether the Philippines is a beneficiary of this trade war or not. You know, we don't think that we are going to be hurt by it, but at the same time, you know, the foreign investors, they kind of don't care. They're looking at it from a big picture perspective, and they're just focusing on the fact that China accounts for a big chunk of the emerging markets index.
Parang nasasama lang tayo sa benta nila of emerging markets. Kasama talaga. All right. Moving on, let's ask Juanes about what are your views on on the U.S. markets, the yields and the strength of the U.S. dollar, since April has talked about it also.
Well, the S&P 500, I'll use this rather than the Dow because clearly this particular index measures a bigger basket of more essential stocks. And you can see the picture there is showing you a worked up recovery in a channel. The only thing I'm going to feel apprehensive about right now is that we're hitting the previous high. And you know, there's the potential that if we hit into this major resistance point that the market might attempt to be able to subside again. So as an external impact to us, any pullback from here might cause some volatility back into our market as well. In fact, last night and the day before, we've had bad earnings by tech companies like Facebook and Twitter. When Facebook came out with its earnings, it dropped by 18, 19% in a single day, losing $120 billion in value. And last night, Twitter fell down by 20% and it lost $6.6 billion in value. And you get concerned that is this setting a trend of tech companies? The Nasdaq was down more than 1% last night, also under the same circumstance. So it feels that the US may have to come down, and that might trigger some influence into our market as well. In terms of the bond yield, the US bond yield, and just to let you know why we watch this, is because the bond yields serve as a precursor, or it serves as a benchmark to see how interest rates in the US are faring. So if yields like that picture starts going higher, there's an expectation that interest rates will more likely do the same thing. And so we watch this very closely, because if this starts running up a bit more aggressively than the way it should, which is more gradual, then that will put more concern that do they need to raise rates faster? Or is it going to be more sustainable? Or will it cap itself next year, like what we are anticipating, hopefully? But we don't know. We will see how it goes. But so far, the graph still shows that it's locked into a consolidation range after pulling back heavily. And as long as it stays between that red and blue line, then we should be okay. There shouldn't be nothing adverse coming into it. But I think April explained earlier on that, remember, it's not as simple as only in the US. You're looking at everything happening around the world at the same time. The fear in the last few days is that the Bank of Japan may start to be able to cut back on all the stimulus efforts they're doing, and if that happens, there might be another push up in rates across the globe. And that's why the bond market in the US sank quite heavily, and that's why that's going up the way you see it right now. So we're going to be watching that carefully into the next few periods. But this is clear. I hope that it's going to taper. I mean, that's what I want to happen, because if that happens, it might allow some breathing space for our market. If not, and you better be prepared, there might be some more reactions. Then, into the concern of the dollar, I think you can see right there that the dollar shot up very, very strongly. It's now going sideways, and the band of that sideways move is slowly starting to narrow. As that starts to move and narrow down, it's going to force a decision out of that dollar, I'm saying, in the next few weeks. So I think in the next 2 or 3 weeks, that movement is going to push out of that band, and we've got our fingers crossed that we hope it goes down. Because like April pointed out, if that starts to go up and you have that impact, and you've got some currencies going back into a little bit more of chaos, and people tend to be more defensive, and too much volatility into the currency market is obviously there. So you're going to have to watch this into the next couple of weeks.
I guess I have a question for you guys. Now, we are looking at the 10-year US Treasury. But if you observe the short-term rates, the 2-year rates, it's actually moving faster than the 10-year. So is this something that we should also look at? What do you think? Because in terms of, for instance, a risk-off behavior, I think, to me, I'd look at the 2-year more.
So yung flattening of the
Yes,
yield
the flattening of the
curve.
yield curves.
Yeah, I think people are worried about the flattening of the yield curve because historically it has been, associated with bear markets. Not really flattening, but inversion, where the short term is higher than the long term. But there have been several theories as to why this is, and even the economists themselves can't seem to agree as to what is the reason for it. But from a pragmatic perspective, usually rates in the short term go up substantially because there's a bubble and the Fed will try to tighten significantly. No? Whereas, of course, over the long term, they expect the economy to, say, perform poorly. That's why the short-term rates are down. But I mean, now that's not it. People are just saying, "Nako, we're worried. It might invert, diba?" So, I don't think it's conclusive at this point. But I think when you read the papers and the blogs and everything, everybody will talk about possible yield curve inversion as a concern for them.
At this point, nothing to worry about. Again, let's go to our Slido app to see if we have any questions related to this topic. So, guys, do we have questions? Yon from Mr. Romulo. Trade war between US and China is imminent. How will it affect our financial market, and what are the necessary actions and precautions that we have to take?
Okay, so the trade war. Again, I think it's, well, I write a column pala, sort of plug, no, once a week. And that's one of the things I talked about. We're not really a very export-dependent country. So that said, I don't think we're going to be affected much. And think about the targets being, called upon by Trump right now. You have Canada, China, Mexico, diba, Brazil, whatever. You can just do a Google search and look at countries with huge trade deficits or U.S. trade deficit. Who are the countries which export a lot more to the U.S. versus import? And, yun nga, it's China, EU, Canada, and Brazil, Mexico. Not the Philippines, baka nga, trade surplus pa sila sa atin. So, I don't think we really are, or they will target us. They're going after the big fish. And, that said, we had this interesting meeting last week with the semiconductor company who said that, this is the chance of a lifetime for the Philippines. We're actually very excited. The demand for our services is, beyond expectation. That's what they said. Because of the US-China trade war. Siyempre, nung una, medyo nagulat kami. Bakit ganon? Sabi nila, well, think about it. Sabi niya, the companies, when in the past, they always don't want to go to the Philippines because they talk about our limitations in terms of supply chain, blah, 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 China being more efficient and all of that. But now, they're thinking we need some risk management measures. And what if the trade war intensifies there? We need to bring out certain volume to Southeast Asia, to countries like Philippines, Thailand. And, the exports coming out of China on the IT side is super big, that even if we get a small portion of it here, it's a big boost to our manufacturing. And our labor costs are not expensive anymore. They're actually very happy that the peso has depreciated. They said our labor cost is actually cheaper compared to Thailand. And then they said, the people here, well, it's more difficult to train initially, but they said the workers are more loyal and they're younger. So they said that's the reason why they're very excited about the Philippines. So, I mean, let's not be too bearish. We could actually benefit from the trade war.
Right. In fact, to what you mentioned, I think in terms of the furniture industry, which is part of the list of Mr. Trump of tariffs, Thailand is also, Vietnam rather, was having a good time because now the US is going to source their furniture from Thailand, or in the fact that soybean is part of the tariffs imposed by China on the US. Brazil soy prices are now really high, right?